All right. Good day, everyone. Welcome to the Loan Officer Training Series with the Mortgage Calculator. Give us just a moment here to go live on all the platforms. Appreciate everybody tuning in nice and early. Definitely an important training here today. Definitely, probably the number one thing you need to know for non QM loans, which is something that we specialize in. So, definitely super important training here today for everybody to know the basics of this at the very least. So it looks like we're live on all the platforms. We'll go ahead and get it started here. You can go ahead and keep dropping comments there in the chat as you tune in, and you can also drop any questions you have, and we'll be happy to answer them after the presentation. So, welcome everyone. My name is Kyle Hershey. I am the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our CSO, Jose Gonzalez. We are a lender that specializes in non QM loans. And what we do every Tuesday, Wednesday, Thursday at 12 p.m. Eastern is our loan officer training, where we go through a new loan officer training topic, an in depth training. And today is going to be very important, mastering variable income. So, I'll turn it over to Jose. I'm sure we probably got some great stuff to get into here. So go ahead and take it over, Jose.
All right. Good afternoon or good morning, everyone, for those of you on the West Coast, since we do have quite a few MLOs on the West Coast of the US and actually even in Hawaii. So, this is a good one because production is ramping up in the agency side in the full doc type loans, right? I mean, non QM, alt doc has been totally popping in the last 2 years, but now with the lowering of the rates, we are getting more interest in the full doc borrowers, and definitely variable income is one of those categories that you have to be able to master to be able to properly calculate your income, right? Got to do a thorough income analysis. It's not just grab the pay stubs, multiply the hourly rate by 40 hours, grab everything that's in there, and you're done. No, you got to break them down. And that's what I'm going to assist you with here today in the theory on how to analyze it, right? We're not so much going to look at show you how to calculate, but show you how to analyze so you know what you need to calculate. That's usually where people miss a step, is they don't realize what they have to actually review. It's not so much the mechanics of the math, it's what you're actually analyzing. So let's break it down here. When we're talking about variable income, what are we actually referring to? And this is a critical point here, right? Variable income is income that is calculated by an averaging, that's the important word here, averaging method, and can vary depending on the situation. Now, what we mean by that is, in terms of averaging, depending what type of variable income you have is what you're going to average, right? Are you looking 2 years back, or are you considering year to date as well, or what's the probability of its continuance in the future, right? Those are all different considerations that you make depending on the type of variable income that we're analyzing. Now, it's very important to note that variable income is applicable to all borrower types, right? It's applicable to your hourly borrower, it's applicable to your salaried borrower, and it's also applicable to your self employed borrowers. Right? So it just depends on what the income stream is, but there's could be a variable component there, especially right with the self-employed. Their income alone itself is usually going to have to be averaged, unless you pick a 1 year option for non-QM, or unless you happen to get the 1 year findings from AUS if it's an agency loan. So variable income, excuse me, we're looking at commission income. That's the most commonly known type of variable income. Tip income, right? That's a service industry type income. Um, Bonuses for our salaried borrowers, but you could also be an hourly borrower getting a bonus. Overtime, which is going to be mainly for our hourly borrowers only. Commission could be for anybody. You could be hourly salary or self-employed and be getting commissions from different types. Um, Automobile allowance. Now that's a tougher one to recapture because it would have to be taxed, a taxable benefit, right? Automobile allowance. Capital gains income, that's another of those categories that you have to be very careful if you're trying to use it because you got to show a longer track record than usual. They might want you to go back 3 years instead of 2 years and show a good solid year to date and show a good solid letter of what's to come as well. Interest income and dividends income, right? Those are all, those last three are what's the probability of its continuance. And you'll see when we get into the presentation now, but each of these types of variable income, and the list is not limited just to this, but these are the most common ones. Some get treated the same, others get treated differently. And what's going to determine that is, are you just determining its continuance moving forward, or are you also looking at um, the historical receipt of the amount as well, right? As far as your averaging goes. So, what type of challenges do we face when we have a borrower with variable income? So, again, here we're talking theory. This is not just how to crunch the numbers because that's the easy part. This is how do you look at the data and see and properly interpret what's actually going on. And an unstable or downward trending income is a big red flag. I mean, that's a really bad one if it's really deep. Like if you had 2022 income of 200,000 and 2023 income of 53,000, maybe the 53,000 still allows your borrower to qualify because they realize, listen, okay, I understand. Then let me just get the house that's 200 or 250 or whatever they qualify for. But the underwriter is going to look at that income, and the underwriter is going to say, wait, hold on a minute, Jose. We got a big red flag. This income has decreased by like 300% from 200,000 to 53,000 or whatever the percentage of decrease may be. We need a really good explanation as to what is the reason that the income has declined so drastically, because we need to make a determination as to, is this company even going to be existing a year from now? If this downward trend is still going down, they're at 53 now, where will they be next year? 20? Right? That's a kind of question. That's what's going to be going through the underwriter's mind. So there's going to have to be some good documentation provided there by the borrower and by their accountant, and good explanations as to what is really going on. So it's really maybe they just did a realignment of something. Maybe they sold off one of the divisions, but they kept another division. So whatever it is, it needs to be properly documented, because if the figure is too low, the underwriter may just deny the loan based on the unstable and declining trend. Uh, Documentation must support a history of receipt of the income, to be able to also document the amount, the frequency, and the duration of the income. So you're going to look at a history of the receipt of the income, and then within that historical data that you have, you're going to see, okay, with each payment, were they paid every month? Were they paid every 3 months? Were they paid every 6 months? Were they paid once a year? Once every 2 years? How much were they paid? And paid for? Is there a duration? Is there an expiration to this? So that may be available on the document that supports why they're even receiving that. But on the other hand, if the needed history is not provided, or the amounts do not support the value, in other words, the income that we're calculating, then the income is either going to be adjusted to the proper level, or may not be able to be used at all if it's deemed to be too sporadic and not on a continual basis. So those are all things, mind you. We're just looking at the data here. We're not even looking at the amount. We're not looking at the DTI. We're just looking at it since it is variable income. Are we even going to be able to use it? And what do we need to provide to be able to properly document it and taking into consideration these issues, potential issues that we're facing here, which takes us to now, excuse me, category number 3, continuity of income. Now, notice this one, we've divided into 2 categories. Well, not we, but it is, divided into 2 categories. One would be a type of continuous type of income with no defined expiration date, right? There's no contract to it. It's just something that's happening, like capital gains, where your borrower is either flipping homes to get capital gains, or maybe selling stocks, trading stocks to get capital gains, or foreign exchange to get capital gains. Whatever that activity is, you're going to need to document at least 24 months history. Now, less time may be considered within between 12 and 24 months of receipt may be considered, but that's a maybe. A given is going to be 24, and in some cases they may ask you for 36. They want to go further back in time to see not so much the money that they're going to calculate using the third year back, but just looking at the trend and looking at the borrower doing the activity. So capital gains, bonuses, overtime, or commissions, those are all variable income types with no defined expiration date. There's no real contract that says, usually at least, that says you're going to work 20 hours of overtime every week at your overtime rate. There may be in some cases, but that's not usual and customary, nor do you know how much commission you're going to be getting. You only know your percentage, but you don't know how many deals you're going to get. So all of that, no defined expiration date. You do need historical data to confirm receipt of the item, and then you need to document how much has been received and do your calculations, and then get your year to date numbers to see if the trend is the same. All of those are different things to be analyzed when you don't have a defined expiration date. And then conversely, we have, which this is a little bit easier now, if you have an income stream tied to a defined expiration date, like for example, notes receivable, right? You lend somebody some money, and they sign a note of that they're an IOU, a note receivable, and you know that for the next 5 years you're supposed to receive $100 a month, which is whatever, $80 principal, $20 interest, for the next 5 years, 60 payments. So, and right now we're in month 14 of the agreement. So, you have whatever, 30, 46 months, I guess, left. So that's definitely 3 or more years continuance for an income stream with a defined expiration date. Always minimum 3 more years. So notes receivable could be one. Pension plan or retirement distributions is another very popular one. Or royalty payments, right? You sold the business and they're paying you every year a certain percentage for a defined amount of time according to the sales contract, when you sold them your business. So that's another one. You have to look at the contract and see until when the income stream will be active, and make sure that it's at least 3 more years of a continuance. And now I'm touching here a little bit more on pension plans, right? Pension plans and retirement plan distributions in general, because this is the one that we see a lot. And you just have to understand now, in the context that we're seeing here, that because a pension plan has a defined expiration date at some point, the expiration date could be upon the death of the beneficiary, right? It's our individual borrower, some pension plan they had from whenever they work somewhere else, right? But you're still going to need the terms and conditions of the pension plan to determine that it's going to continue for at least 3 more years. We will need something in writing from somebody, preferably from some type of handbook or manual or something where it says, or maybe the actual agreement that they have when they were enrolled in the pension plan that says until when they're going to receive that benefit. That is key. So whenever you do have anybody, they give you a 1099 for a pension plan, please ask them for that information because you will need that information for a pension plan. Don't hold your deal up on that. So, lastly, here we talk about some more solutions with no defined expiration date, right? Because these are the ones that are a little bit tougher for us to deal with, right? The overtime, the commission, the bonuses, right? With no defined expiration date is very difficult. That's why always when we're reviewing those files and we see those pay stubs, like for the nurses, for example, everyone knows the nurses' pay stubs. Those are the one of the more complicated pay stubs you're going to see because they got their base pay, education, overtime, shift differential, night shift differential, holiday differential. I mean, then they got some paid time off and a little bit of vacation time thrown in there. And I mean, it's all sorts of stuff. You could have 10, 11, 12 categories in a pay stub, and what is base pay and what is other and what is variable pay, right? That's where you got to get some clarification. The bar needs to get some clarification from their HR. Sometimes they can even provide you like some kind of a document that has to get, and it explains pretty clearly. But do be aware that when you do have those complicated variable income situation, the one of the best uh, things you can do right away is order a written verification of employment, WVOE. The written, get that borrower certification and authorization signed and send it along with the written verification of employment to the whoever is the authorized contact to complete the form at the employer, or maybe the employer uses one of the third party verification services. Fine, they'll just need to let you know that's what they do. You send it to the appropriate service, you get your written verification of employment, and it's going to have it broken down for you nicely: base pay, overtime, bonus, and other as applicable, right? Like for the education reimbursements, usually go into other. So then the good thing is you're going to have the historical data. Usually, if they've been at that employment, if not, you need to get written verification to go cover a total of 2 years for that variable income, right? So hopefully they'll have it covered. If the bar has been there at least 2 years, you have your breakdown of everything. Is this continuance likely, which is one of the questions on the written verification of employment for bonus and for overtime, average hours worked per week, and even box 20 for some remarks that they may want to put. Sign it, return it to you, and now you can properly calculate the variable income for your borrower without any doubts. Always best to have that written verification form up front before you submit to underwriting so that you don't get a lot of needless conditions. Now, it's sometimes you don't have time, but you have the year end pay stubs. That's good if it's not too complicated of an income like for a nurse. If all you're dealing with is overtime, bonus, and base pay, then that's fine. If you have the year end pay stubs for example, 2022 and 2023, and then you have the year to date 2024, you can make some good calculations there. If there's no, again, and if there's no gray areas regarding what type of category we're talking about, and is it base pay or is it other? So now, when you do have some defined expiration dates, it's going to be a lot easier because then you're going to be looking at the actual document, right? The note receivable is going to tell you when the income is going to end. The royalty income is going to be based on the sales contract. It's going to tell you when the income is going to end. And if it's like a restricted stock income, that's a one-time event, usually, not going to be a recurring event. last but not least, um, the tip income is the one that's going to be hard to document anywhere other than tax returns. That's it. Tax returns. There's no other way to document that tip income. Um, if they don't claim it on the tax returns, if you're going with a full doc borrower. Now, in some cases, right, there's always a little bit of an exception. In some cases, in some companies where they pay their employees a certain percentage, they'll pay them a base hourly, and then they'll pay them a certain percentage in tips, and they actually pay those with a W 2. Now, they may still receive cash tips that they have to declare. These would be tips that were paid, included, for example, with the credit card. Customer tips through the credit card, they're going to get that as tip income. And then that case, it is put in the W 2 in a separate category, sometimes as tips income. So just do be aware of that. I just had that recently with a chef where he had his base pay and then he received amount of, I guess, tips that they give to the service staff, including the chef. So he had his extra tips income. And then on top of that, he was declaring a little bit extra. I guess he knew last year he was going to buy a house, right? Last 2 years, so he declared even a little bit extra on both for the cash portion that he received in tips income. And we were able to qualify him because he was declaring the income. But if it's not on the W 2 and it's not on the tax return, then the only way you're going to be able to capture it somehow is through some type of self-employed type program for self-employed borrowers, where you're looking at bank statements. But if they're not a self-employed borrower, then that's not going to be an option. So do be aware how we can verify. What are the solutions to all of these different verifications. Do be aware that how we analyze the no defined expiration date versus a defined expiration date, and that's going to determine the type of documentation that you need. So hopefully this has made the math simpler for you all, because now you know exactly what you'll need to analyze for your borrower. And remember, if they are self-employed, do look not just for the Schedule C's on the 1040, but also look to see if they have a partnership with someone where they're going to receive a 1065 report, or if they actually have a vested interest in an S corp where they're going to also receive an 1120S. Hope this helps to income bars.
All right. Thank you, Jose. Great information there. I don't see any questions yet, but definitely very important stuff that we all need to know. And of course, this is recorded and on our YouTube channel, so you can always go back and watch it when you do come across a borrower with this type of variable income, and make sure you're going through the right process. So I still don't see any questions. We'll go ahead and wrap it up. Remember that we do this training on every Tuesday, Wednesday, and Thursday at 12 p.m. Eastern, where we go through a loan officer training topic and a deep dive into it. So we will be back here tomorrow at 12 p.m. Eastern for the next episode of the Loan Officer Training Series with the Mortgage Calculator.